Well, 1 week from today, federal taxes are due, so chances are you've already filed this year's forms. But today, we kick off a week-long series of tax tips to consider ahead of next year's filings. Some big changes in tax laws going into effect in 2013 might force many top earners to consider making significant changes right now to their retirement savings accounts. Sharon Epperson explains.
Attorney Doug Bramley usually gets a tax refund each spring, but he's not counting on one this year or in the future.
That's no longer going to happen. As my tax burden increases, I'm paying more and more in taxes. I'm not getting tax refunds, and we're having to plan financially for that.
Top earners like Bramley will take a big tax hit this year on earned and investment income. For couples with incomes over $450,000, $400,000 if you're single, increases in federal income tax and a Medicare surtax will result in a total tax hit of nearly 42% on earned income in 2013, a more than 5% increase over last year. Plus, taxes on dividends and long-term capital gains have surged almost 9% compared to last year to nearly 24% for top earners. And the tax on interest income in 2013 is a whopping 43%. Facing a potential tax hit like this is forcing households like Bramley's to make some changes.
We have already done as a family a lot of planning in anticipation of the fact that my income is going to be a little bit lower next year because of these big tax bites.
Big changes for portfolio planning may lie ahead too. Financial advisors say new tax hikes increase the need for diversification and new strategies when investing for your financial future.
Maybe buying some stocks for growth purposes that aren't paying dividends, that maybe give you the same result in the end, but have a little less tax implication. So that's one. Two, make sure that after you look at your non-qualified money, you go to your tax-deductible money, your 401ks, your 403bs, your IRAs, and make sure that you're absolutely maximizing those opportunities.
Contributing the maximum amount to a 401k, up to $17,500 this year or $23,000 if you're 50 or older, will reduce your taxable income. Convert a regular IRA to a Roth IRA, you'll be taxed on the money you convert, but you can generally take the money out tax-free after age 59 and a half. And keep a taxable account in the mix, although putting more dollars there may be less attractive now.
With the tax increase coming up, we're going to be putting more and more money into my Roth IRA and my traditional IRA.
For many, a varied investment strategy for an uncertain tax landscape is an imperative.
We're going to get back to really managing investments as to what the tax liability might be, and those folks who manage it the best will get to the finish line first.
For Nightly Business Report, I'm Sharon Epperson.